IUL passes the liquidity test far better than most money in IRAs and 401ks. In this episode, I'm going to answer the question, how liquid is money in an IUL, Indexed Universal Life? Get ready, far more liquid than maybe you think. So, my name's Doug Andrew, and I've been a financial strategist and retirement planning specialist now for north of 48 years. And so sometimes people may go, well, what does he know? Well, I actually began selling Universal Life when it was first introduced by E.F. Hutton back in 1980. And when Indexed Universal Life came out in 1997, I was one of the very first proponents of Indexed Universal Life. And so I've written several books about this topic. In fact, I've been blessed in my life to have authored thus far 12 books. And at the end of this episode, I want to gift one of those books to you if this is intriguing you. But I get asked questions all over the country because I've spoken to live audiences more than 90,000 hours in my life. And many times people have the question when they learn about IUL, Indexed Universal Life, they go, well, come on, Doug, really, how liquid is the money in that IUL? Because maybe they've had naysayers say, well, I don't believe you can earn rates of return of 8 to 10% average in those and what have you. And I go, oh, you have no idea. So get ready. I'm going to talk about how liquid money is to access for emergencies or business opportunities or whatever you need the money for out of an IUL. Actually, far better than money that you might be tempted to grab out of an IRA or 401k or money in a mutual fund. So here we go. So life is unpredictable and things happen where sometimes we need to access money in an emergency. Now, most emergencies do not require that we have to have a drive-up window to go down and access money within an hour, but if those emergencies happen, you can actually arrange to get money pretty quick out of an IUL policy. Most emergencies, if you could access money, $10,000, $50,000, $100,000, $1 million within 3 to 5 days, that's usually adequate because most emergencies don't require instant money in your hand. So let's go through a few scenarios. Many times as I listen to my clients and my students, if something comes up, an opportunity or an emergency, and they need money, many people go, well, golly, I don't have access to any. I don't have time to apply for a loan and get approved from the bank or credit union. And so they look at their resources where they have money. Now, most Americans, unfortunately, have most of their money sort of trapped in traditional accounts like IRAs and 401ks, 403bs and the like, or annuities, maybe money in the market in mutual funds or stocks and bonds. So can you go get money in those? Yes. Are they liquid? Yeah, you can access money, but what normally happens when you access money out of an IRA or 401k, and if you're under the age of 59 and a half, what's going to happen? They will penalize you, and I'm talking about the IRS. There's a 10% penalty, and you're going to have to pay tax. So if you pull out, $100,000, you may have to pay tax that year on that money that you withdraw because now you've taken money out and it becomes taxable, but there's a 10% penalty. So if you are in a 30% combined federal and state tax bracket plus the 10% penalty, you're going to pay 40 cents on the dollar. You pull out $100,000, you're really only netting $60,000 because of the taxes and the penalties. So sometimes you can borrow money out of an IRA or 401k if your employer, allows you to do that out of a 401k, but you must pay it back, and maybe you don't have the wherewithal to do that. So there's usually issues from a tax standpoint and a penalty standpoint if you're under the age of 59 and a half. Now, what about money in the market? Let's talk about that. If you have money in a mutual fund or stocks, bonds, or whatever, and you need to access some of that, the market may be down. And so if you redeem your mutual fund shares or you sell your stocks, it may be poor timing, and you may be tempted to go, golly, I got to time the market. I've got to wait until the market comes back. We had a crash yesterday and it dipped 10%. I don't want to sell my shares low, and because we have a tendency to want to take out or sell our shares, redeem them in a mutual fund at the high water mark, the highest point it's been to. So sometimes market timing interferes and causes frustration and heartburn when you access money out of the market via stocks, mutual funds, or what have you. That's why I love accessing money out of an IUL policy. In fact, it's one of the purposes. It can become one of the best emergency funds ever. Now, some people say, well, maybe you ought to have some money in a bank or credit union because they have a drive-up window. Yeah, why would you put money in a bank or credit union, especially 100, 200,000 or more, when they only credit you less than 1%? You're rowing upstream at the rate of 1 mile an hour, so to speak, and the current of inflation's coming down. At the recording of this video, the actual rate of inflation is over 15%. See, you're going backwards. So IUL becomes the superb emergency fund to access money because you're earning a higher rate of return, and it's actually safer than money in a bank or credit union because frankly that's where banks and credit unions put your money. Up to 30 to 40% of their tier 1 assets are in insurance companies for liquidity and safety. I said liquidity. So let me address how easy it is to access money out of an IUL. Now, if this is already intriguing you, I would strongly recommend that you subscribe to this channel. Why? Well, I post an in-depth answer to a question like this almost on a daily basis. It's a free subscription, and click the little bell so you'll be notified every time I post a new video. I don't want you to miss out. And I have over 725 educational videos on this channel. But stay with me to the end because I'm going to gift you a copy of my most recent best-selling book. It's 300 pages called The Laser Fund. And it will explain what I'm talking about even in more detail. So an IUL policy, most of my students that I mentor and my clients for years, they came to me not necessarily wanting or needing life insurance for a death benefit. That wasn't their primary objective. It was to be able to put their money somewhere that was liquid, safe, earning a great rate of return for goals such as retirement. And in other episodes, I talk about why a max-funded IUL will knock the socks off of most IRAs and 401ks from a tax standpoint, rate of return, and so forth. Let me just address the liquidity. So if you're putting in the maximum amount of money, because that's the objective with a max-funded IUL, you want to put in the most money that the IRS allows as fast as they allow and take the least amount of insurance you can get away with. So let's say you're 60 years old and you want to reposition $500,000. Well, about the fastest you can put that $500,000 in to grandfather yourself so that you can access money anytime without triggering tax would be about $100,000 a year, maybe up to $125,000 a year. So let's say this is your policy, and sometimes I compare this to a bucket. So you're going to put in $100,000 to $125,000 a year, and you put that in, and the policies may be only 20% funded. Well, what if you need some of that money? You can actually access that money with an electronic funds transfer, a phone call if you need to, or in another episode I'll talk about how most people do it if they're not in a hurry. But the point is this, if you put in $100,000 and that policy is only 20% funded, you could still access probably 20, 30, 40,000 by just withdrawing it, but that's not the smart way. In another episode I'll talk about the smartest way versus just withdrawing the money. But you can do that. But most people, if they're setting it aside and they had other money, they go there for liquidity, not the insurance contract until it's fully funded. So you put in $100,000, another 100, and let's say in 4 years and 1 day, you finally have paid all 5 payments into the policy, and now you have $500,000 in there. Well, what if you need some money? You can go access about 92 up to 95% of that, and you want to do it the smart way. So check out my other episodes that talk about that. And you simply access the money. It's extremely liquid. Are there any taxes that are triggered? No, not if you do it right. There's no penalties by the IRS. You don't have to wait and time the market. And so you don't have any of those issues, and you can access that money. And if that $500,000 in 7 years, like with a lot of my clients, it doubles in 7 years to $1 million, you can access that money very easily. So let me make sure you understand the liquidity of an IUL. So in other related episodes, I'll talk about 3 ways to access money out of an IUL: the sad way, the dumb way, and the smart way. Make sure you watch that, because you want to access the money the smart way, and you're going to be blown away with why that is so critical. But in this episode, I just want to assure you that when you set aside money and accumulate it in a maximum funded indexed universal life policy, it passes the liquidity test with flying colors. On a scale of 1 to 10, 1 being very illiquid, 10 being super liquid, I would rate it 9 or 10. Only during the first few years, if you needed access to 100% of your money, then maybe you might not be able to do that while you're still in the funding process without sort of killing the policy or causing it to lapse or cancel it. So I'll give you one last little example here. Years ago, I had a woman come to me. Her name was Beverly, and she gave me $200,000. This was before the TAMRA law, and she dropped it in the policy. She says, "I'm not going to touch this for 20 years. Well, it wasn't even 6 weeks, and she had an accident. She called me from California. She said, "Doug, I got to have $120,000 of that $200,000. How long will it take?" And I said, "Oh, just a few days." She called me 2 days later and said, "Doug, how long will that take again?" And I said, "Have you checked at home?" And her brother was there. And Federal Express, because I arranged for that, had already delivered the $120,000 check. In this day and age, she could have done that electronically. So how liquid is money in an IUL? Extremely. You can access money when you need it, even with an electronic funds transfer or phone call. So again, if this is resonating with you, subscribe to this channel. But more important than that, I want to gift you a free copy of my most recent best-selling book. This is what I mentioned, the Laser Fund. That's what I call a max-funded IUL. This will teach you how to diversify and create the foundation for a tax-free retirement, and why a max-funded IUL is like a financial Swiss Army knife. And one of the functions, other than retirement savings, working capital for business, real estate management, that people set up IUL policies is for an emergency fund because of the liquidity. So if you click on the link below or go to laserfund.com and you contribute a nominal amount towards the shipping and handling, I'll cover the rest of that cost, and I'll pay for the book, and I'll fire out this 300-page copy to you. Now, it's actually 2 books in one. This side is 14 chapters, about 200 pages, with all the charts and graphs and explanations. If you're more of a right brain thinker, you flip it over and read this one, 100 pages, 12 chapters, with 62 chicken soup for the financial soul stories. If you want to use both your right brain and left brain, you can read both, okay? So go to laserfund.com, click on the link below, and then when you're in there, there's also options and opportunities for you to subscribe to educational webinars, Retire by Design events. So be sure and check that out.